A very good morning to you all. Welcome to today's Cal Finlit session, which is on Beyond the Ballot, how you should change your investment landscape in a post-election scenario. So in today's session, we will look at, firstly, how the macro variables have changed before and after the elections, and what does it mean going into a post-election period, and how you should look at changing your investment portfolio given the change in the political risk as well as the change in macro landscape. Right? So first, let's look at how the Treasury bond rates have reacted leading up to the presidential elections and after the elections. Right? So we saw Treasury bond rates. Here we are demonstrating a 5-year bond where the rates fell down to about 11.3% somewhere in June 2024. And thereafter, closer to the elections, we saw yields even jumping to close to about 13.5%, 14 on a 5-year instrument. And now, after the elections, we've seen the yields come down to about 11.85, 11.9% as of the recent secondary market data available. Right? So still, the rates are 53 basis points higher than what it used to be at as of June 2024. Right? So we've seen some kind of adjustment on the correction on the Treasury bond rates, but not a full adjustment has happened as of yet. From an equity market perspective, a similar kind of story. We saw the equity market rise significantly leading up to the elections, or 2 months or 3 months before the elections, where the index went to about 12,500. And thereafter, we saw a very steep correction in terms of the equity index, where the index fell close to about 10,500 points. But subsequent to the elections, we've seen the market gain momentum, and the index now reaching close to about 12,000, 12,100. Right? But still, the index is 500 points, almost 500 points, lower than what it was during the peak in May. Right? So have things changed? What has changed? Has the risk been taken out? Right? Or is there more room for upward movement in terms of all the markets? From an exchange rate perspective, exchange rates, on the other hand, also saw a slight increase leading up to the elections. But thereafter, we have seen a correction in terms of the exchange rate, where exchange rates have fallen even below what it was in a pre-election scenario. And a couple of reasons why we attribute this to. A, there has been an increase in terms of worker remittances. Imports have slowed down a bit, and we are going into a tourism season. So all this combination of this, the exchange rates have been kept relatively under control at 293, 295 levels. Right? So exchange rates, to be honest, have fallen more than what it was in a pre-election scenario. Right? So what we need to kind of determine is, have the underlying fundamentals changed after the presidential elections? Right? So we said that bond rates haven't come down to what it was before. Equity market hasn't gone up to what it was before. Right? But is there a change in terms of the fundamentals which kind of rationalize such a change in terms of why the market shouldn't go up or rates shouldn't come down as such? Right? So let's look at, in terms of policy and what the government and the central bank has been doing in a post-election scenario. Have things changed? From a monetary money printing perspective, the central bank still doesn't print money, even after the elections. Even when during the peak in September, when there was a little bit of pressure on the interest rates and so on, we didn't see the central bank printing money to kind of manage its fiscal position. Right? And also in a subsequent period, the central bank keeps, or its intention is to reduce its amount of holding of government securities, or not print, or reduce its amount of printing that is there. Right? So from a policy perspective, we haven't seen the central bank tilting in terms of or changing their policy in terms of printing as such. Right? Second one, from a government's perspective, the government's tax collection still remains strong. Right? So a lot of people expected tax collections to slow down in September leading up to the elections and so on, but To be honest, as of September, the IRD, for example, has collected 70% of what it should have collected for the year, and is well in line to hit the target for the year. Similarly, we are also seeing customs is in line to hit the annual target. So more or less, revenue collections have also been strong leading up and in the subsequent periods after the presidential election. Right? So we haven't seen the government tilting too much, government and the central bank tilting too much in terms of either fiscal stance and from a policy stance from a central bank, where they are looking at funding the budget deficit through printing. So that is continuing even in this political regime. Right? So there are few things which have been imposed by the previous government or the acts which were brought in last 2 years subsequent to the IMF program that we entered to. There were few acts which were that came in, which kind of restricts any government to do too many changes in terms of public finance management or central bank policy. Right? Now, because of these control measures being in place, even the new government or the central bank in power cannot make major changes to whatever that was happening in the last 2 years, right? Or the policies that they were adopting in the last 2 years. For example, the Central Bank Act, which came in 2023, ensured that the independence of the central bank is maintained, monetary printing is prohibited, right? And that Sri Lanka follows an inflation targeting framework, right? And we see the current government is also kind of in line or favorable to this, where they are saying that there will be no printing and they will follow the Central Bank Act, right? And from a Public Finance Management Act, right? The Public Financial Management Act capped how much expenses that can be made by the government on a recurring basis, right? So primary expenses were capped at 13%, right? And any government guaranteed debt was capped at 7.5%, right? Similarly, the Economic Transformation Bill, right, set targets in terms of how much debt to GDP that we need to work with, which is in line with IMF targets and so on, right? So these broad acts which have been brought in restricts any new government or central bank to make drastic changes in terms of policy, right? So unless otherwise the government goes and changes the acts with a 51% majority, you won't see a lot of these policies which are in place going to change, right? So question is, if the government is not going to do major fiscal slippage, or central bank is not going to go is not going to take a very accommodative stance by printing and so on, right? Is there a requirement where market should panic and risk should increase as such, right? So our view is no, right? Because more or less most of the policies are in place, right? So you haven't seen any change in terms of the underlying policy framework, right? So basically it's a continuation of the existing policies with the IMF framework in place, right? So in that case, what we can expect is that markets will take it positively going into a post-election scenario. Also, the new government which has come into power has been very clear that their commitment to the IMF program will continue, right? Now, when they say that their commitment to the IMF program will continue, that means that they are going to stick to the main target stipulated by the IMF, right? When you say main target, a 2.3% primary surplus, which is your revenue minus cost, debt to GDP being brought down to 95%, gross financing needs falling below 13%. And also your sub-targets in terms of hitting a government revenue to GDP target of 15%, following a cost-reflective energy pricing formula, flexible exchange rates, completion of EDR. So the broad targets are still in place, right? So when the government gives a commitment to the IMF, this means that these targets will be still in place, right? But where the government can tilt the equation a bit is by cutting down on certain expenses and so on, right? But giving something on the other side to the low end of the population and so on, right? So you can make minor twists within the overall equation, but you should still hit your overall target. So the overall targets won't change, But how you hit those targets can change by the government deciding on if they want to introduce a different tax and give a subsidy to something else, right? So the overall framework still remains the same. How you achieve it can be tilted a bit by the government, right? So which is what this government is most likely to do, which is tilting the equation of how to achieve these targets without changing the overall targets as such. Right? So also we saw a lot of promises given by the government just before the elections, presidential elections. We saw some of them have been already implemented. For example, a pension allowance of 3,000 rupees, a fertilizer and fuel subsidy which was given, which totally cost about 45 billion rupees. And the one spending from their manifesto is increasing the pay threshold to 200K, which will be a loss of about 60 billion rupees in terms of revenue to the government. Removal of VAT on essential items, which is about a 10 billion hit. And also a minimum financial grant of 10,000 rupees to low-income families, which will cost about 171 billion rupees, right? But the government has not clearly said that whether Aswasuma program will be taken out and it will be replaced by this. If so, that increase will also be very minimal, right? So if these incentives are going to be given, right, will this derail us? Will this derail us from the IMF program, right? The answer is no, right? So if you look at the primary surplus, right? So we all know that Sri Lanka has to hit a primary surplus of 2.3% of GDP by 2025, right? So this year we will end up close to about 800 to 900 billion in terms of primary surplus, right? And the increase in revenue that will come in is mainly targeted from vehicle taxes and possibly a rental imputed tax, right? And obviously improvement in collections, right? So we roughly estimate that improvement in tax collections will be about 300 billion, right? And also all the tax incentives that we spoke about and the salary increases, factoring those into account, the loss of revenue to the government will be about 286 billion, right? So the government is making incrementally 300 billion, losing 286 billion from the incentives that they proposed in the manifesto, which will lead us to a primary surplus of about 900 billion rupees by the end of 2025. Now, 900 billion rupees of primary surplus is well above the IMF's primary surplus target of 2.3%, right? So even after giving 286 billion rupees of tax incentives and salary increases, right, the government still will be able to maintain its primary surplus. So this typically shouldn't disrupt your primary balance and the IMF targets, right? So just to recap, so we are looking at a scenario where most of the policies that were followed in the last 1.5 years in terms of the economic policies are going to continue, right? We are still going to be in line with the IMF program, right? And follow the debt restructuring, and most likely we will get the tranche of the IMF by January, February, which will mean that the progress that we made on the economic conditions will continue through 2025-26. So if that was the case, ideally markets should take it positively, and we should expect interest rates to come down, equity markets to move up, and so on, right? So what a primary surplus will mean is that you're basically getting 900 billion more of cash, right? So when you have the government is collecting revenue minus costs, which is 900 billion, right? They can reduce the amount of borrowing that they're doing from the local market. So the amount that they raise from treasury bills and treasury bonds in the market will reduce by this particular number, right? Which will then exert downward pressure on interest rates, right? So that's how we expect interest rates to come down as well, right? So what is our view on interest rates? Because of the primary surplus, we are expecting the government's borrowing requirement to reduce. Central bank has more room to lower policy rates because they were on accommodative policy stance, but with the uncertainties, they kind of postpone the policy rate cuts, right? Thirdly, globally, particularly in the US and so on, interest rates are coming down. So globally, interest rates are on a downward trajectory. Fourth point is that the risk attached to debt restructuring and elections are reducing, right? If a stable government comes into power, and if the president and the parliament are from the same party, then there is a possibility that the risk premium on instruments can reduce even further, right? And also the most likely scenario is that we will complete the external debt restructuring by January or so, right? And the bond exchange happening by March, right? Which will mean that foreign investor confidence will come back. And foreign investor confidence coming back will mean there can be a potential inflow of money coming into debt and equity markets from foreigners, right? And also in the last month and the next 2 months, you will see a lot of foreign dollar inflows, work remittances, tourism, and so on, with more dollars coming in. What the central bank will be doing is central bank will be buying those dollars and infusing rupee liquidity to the market, right? So when there is more rupees put into the market, participation on treasury bills and bonds increases, which will then put downward pressure on interest rates, right? So we have multiple reasons to believe that interest rates should start adjusting downwards, and rates can go even lower than what it was in a pre-election scenario, right? So from a policy rate perspective, the left-hand side chart shows the central bank's inflation graph. So until about third quarter 2025, inflation will be below the 4% mark, right? You see inflation after 2025 third quarter going up to the 6% levels, but that is mainly because of the negative inflation that prevailed in the fourth quarter of 2024 and first quarter of 2025, right? But if you take that out, product prices are not increasing as such, right? Which can prompt the central bank to ease monetary policy rates further, right? So what we look at as the neutral policy rate is somewhere close to about 7% if Sri Lanka is maintaining an average inflation of about 5%. Now, since the Central Bank Act is in place, right, Sri Lanka will follow an inflation targeting model. So we, at the moment, the premium of the policy rates to inflation is very high, right? So there is a possibility that the central bank can cut policy rates further going into 2025. Right? So we're expecting policy rates to also come down, plus the risk premium attached to government bonds and so on will also reduce. Right? So we're looking at a scenario where rates are going to come down. Right? Economy is doing relatively well. We'll probably end the year at about 4.3% GDP growth. So the growth is decent. Right? There'll be a few tax incentives given here and there, but also if you give something, there'll be tightening from the other end. Right? So the government will ramp up its collections because our tax compliance is only about 50 to 60%. So if they improve on tax collections, which they have already started on, then to be honest, the incentives given can be covered to a larger extent by the collections as well. Right? Plus, if vehicles are going to be allowed, vehicles used to be about $1 to $1.5 billion of imports every year. Even if it's a smaller amount, the collections from vehicle taxes will cover up for some of the shortages. Right? So in a scenario like this, what are the investments or what investment asset classes should you be looking at right now? Right? So from a fixed income securities perspective, treasury bonds, treasury bills, debentures are the most attractive ones, followed by unit trusts and equities. Let me go into a little bit of detail on each of them. Right? So if you look at the bank deposit rates right now, bank deposit rates are hovering at about 7.5% to 8%, right? Whereas a 1-year T-bill is between 9.5% to 10%, right? So you have a 2% premium above the bank deposit. And now we know that a treasury bill is a risk-free instrument, right? So a bank deposit is a risky instrument, right? Because there's corporate risk involved. But treasury bill, potentially with Sri Lanka getting out of a debt crisis, the treasury bill will be a risk-free instrument, right? And the risk-free instrument at the moment is trading at a higher rate compared to the bank deposit, right? So that anomaly is temporary and will adjust over time. So these rates won't stay for long. So we believe you should look at locking in these rates when they are higher. Right? Also, when you look at an 8% rate, after you pay taxes, potentially if you're earning more than 300,000, you'll end up paying 36% on your interest income as well, right? Which will mean that you're only making about 5% interest rate net to your hand, right? 5.12% net interest rate, and your inflation is at 5%, you're only making only about 0.95% as real return, which is not enough, right? So an 8% FD return doesn't cover up for the risk that you're taking, or not covering up for the inflation risk that you're taking. And even more than treasury bills, the more viable option is the treasury bonds, right? Now, treasury bonds, for example, the 5-year is hovering between 11.85 to 12%, right? Versus the FD, which is at about 8%, right? Also, we know that rates are going to come down, so we would want to lock in the rate at these levels for the next couple of years, particularly if you have money which you want to lock in or which you can afford to lock in for a long period of time, right? Treasury bonds also are risk-free, right? And you also have the possibility of making capital gains when rates come down in a treasury bond. And the good thing is that if you make capital gains, you only pay a 10% tax on the capital gains as an individual, right? Also, we know that the risk premiums attached to treasury bonds will keep coming down with the election risk and all that kind of being eliminated, right? So this shows the interest rate premium between of treasury bonds versus the policy rates. So compared to policy rates, what kind of a premium did bonds trade at, right? So if you look at the premiums fell down to about 2%, 2.5%, somewhere close to May 2024. At the moment, the premium is somewhere close to about 3.5%, right? So this premium needs to start adjusting downwards, right? Because treasury bonds shouldn't typically trade at such a big premium to the policy rates, right? So this is why we expect the bond rates to even fall further. The other way that you can lock in rates is entering into debentures. We saw a few bank debentures. I think there are a few finance company debentures also coming up. Normally, debentures trade at about 50 basis points to 1% higher than the treasury bond rates, right? And now you should have avoided treasury debentures in a period where the economy is not doing well. But now with the economy doing relatively well, the corporate risk is reducing, right? So it makes sense for you to take on a bit of risk in terms of debentures and so on, right? Because the premium is justified in terms of what you're paying versus what you're getting on a similar kind of fixed deposit. Debentures are issued by corporates, right? And they are normally at a premium to the treasury bonds, and they are long-term instruments. So if you lock in at 12%, let's say, for example, you get that 12% for 5 years every year, right? So it's another product that you can look at. Depends on how many issuers come up with debentures. But at the moment, given that corporate credit risk has reduced with improved economic conditions, debentures are also an attractive asset class. The other two products that we would look at is unit trusts and equities, out of which unit trust, CAL has two main unit trusts, which is what you call the fixed income opportunities fund and the investment grade fund. The fixed income grade opportunities fund gives a rate of about 12%, while the investment grade instrument fund gives about 10.5%. The benefit is that we've been able to lock in good rates when rates were high, and also you have the flexibility in terms of taking in money in and out when you want to, right? So you have the liquidity option as well, so you can use it as an alternative for your savings deposit, right? So unit trusts, given the flexibility and given that the rates are still holding high and at almost about a 3-4% premium to bank deposit, it is an attractive asset class. The benefit comes from being able to, the funds being able to time markets better, being able to lock better, and also get into products which normal citizens won't be able to get into, right? So that's how the yields have been relatively better. And we've been seeing these cycles for a while, which is why we kind of locked in when rates were on its way up. We kind of tend to lock in more instruments at higher rates. And when rates actually coming down, we actually benefit from being part of, or being, because we are already invested in high yield instruments. Right? I think I've explained this before, but the unit trusts also have a tax benefit because you only pay taxation on interest when you realize it. So if you have a need where you don't need the cash flows coming in every year, right? You just want to put away your investments. By keeping the money in a unit trust, you can postpone the realization of income, right? By postponing the realization of income, for example, in year 5 only, if you keep your money in a fund and only withdraw it in 5 years' time, in the 5th year only you have to pay your taxes, right? So that there is a saving on your taxes because of your time value of money impact, right? In FD also, what happens is every year when you get the interest, you will pay the tax on that particular year. Here what happens is, because you're postponing the realization, right, you only pay effectively taxes as at year 4 or year 5, or when you really want to redeem your investment, right? So because of this, there is a tax advantage when it comes to unit trust investments, right? So unit trust investments still are an attractive asset class. So in terms of order of priority, I would think treasury bonds, unit trusts, and treasury bills to a certain extent, right? And a bit of exposure to equities. Now, equities tend to do very well when rates are coming down, right? And that's what we've been seeing. Rates have coming off, and the market has been going off. And this negative correlation has been proved throughout the years, and in a global context also, we've seen this negative relationship between interest rates and markets holding. Also, the turnover has been healthy. We've seen market participants actively trading. The turnover has been building up as such. And foreign buying has also been coming in, right? So typically in countries which complete an external debt restructuring and so on, there is a flow of foreign money that comes into the markets, right? So we have that possibility that Sri Lanka can or may also see some foreign money coming into equity markets after completion of the external credit restructure. Right? However, we also need to keep in mind that the market has moved quite fast in the last 2 weeks. So your RSI is close to about your 80 levels, right? So you need to be a little bit cautious in terms of going aggressively into the equity market, right? And also the market PR is still at about 8 times, which is not very cheap, right? So what can drive the market up is corporate earnings need to continue, and foreign buying needs to continue for the market to maintain this kind of momentum, right? So there is a likelihood that markets can go up, right? But we wouldn't recommend going all into equities right now. So probably a 25 to 30% exposure of your entire portfolio can be allocated towards equities at the moment. Right? From an equities perspective, there are 4 main things that you need to look forward to. And all of these 4 might be positive for the equity markets, right? So one is the parliament elections, and if the parliament elections end up with the same party which wins the parliament and the presidential elections being the same, then the markets will take it positive. And most likely the external debt restructuring will be completed, which means that foreign money can come in. So that is also a possibility, and we're expecting this announcement to come towards December, January, and the exchange of the bonds to happen in somewhere around March. IMF tranche will happen somewhere around February next year. This will be after the budget or the government gives its revenue proposals. And after the external debt restructuring is completed, within a few months, you will see the credit rating agencies upgrading Sri Lanka's credit rating from residual default. So there are few positive events which can trigger the equity market further. Plus, when rates start easing off a bit, you might see the equity markets doing well. Right? So just to summarize, overall, we haven't seen a policy change, right? So do you think rates will go up? No. Have the risk increased? No. Why? Because from a policy framework, we are following the same kind of economic policies, right? And these economic policies, and particularly with the acts in place, right, there is very little leeway for the government and the central bank to do drastic changes which will affect the economy, right? As a result, it should be positive for markets, both from an equity and debt perspective. If you ask me why the currency has come down, that's because of the remittance flows and tourism inflows are very strong right now, and import bill still remains very low, which is why the currency has been appreciating to about 293. So there's another question which says, I was told by finance companies that FD rates are likely to move up to 12 to 13%. Is that correct? Most likely no, because your ceilings on finance company rates and so on are linked to your treasury bond rates. So if your treasury bond rates are going to come down, obviously your finance company deposit ceilings will also come down, right? So most likely those rates will also come down. Also keep in mind the finance company deposits have a higher credit risk compared to your normal corporate securities. Please explain the personal income tax implication on unit trust earnings. So personal income, how it works is in a unit trust, for example, if you put in money, right, and if you don't withdraw the interest into your hands as realized earnings, you don't have to pay tax on that particular year, right? You only pay tax in the year that you take the money out. Let's say, for example, if I put 100,000 rupees and make 10,000 rupees in unit trust returns, if I withdraw the 10,000 rupees, then I have to pay the personal income tax on that component, right? But let's say, for example, if the 100,000, I add the 10,000, I don't withdraw that money, I accumulate it and reinvest it in, or just keep it running in the unit trust, right? I can avoid paying the tax on year one, right? I am postponing my tax payment, right? If I don't withdraw the money out, right? If you don't realize the return, right? You can postpone the income tax payment, right? And if you ask me what tax rate is applicable on the unit trust returns, it works on your normal income tax brackets, 6, 12, 18, 34. So if you're, for example, if you're earning 300,000 rupees already or 350,000 rupees already on your salary or business income, then automatically, even if you make 1 rupee more interest on either FD, unit trust or so on, you still will have to pay 36% on your interest income, right? So your interest, the taxation rate on the interest will depend on where your total income is, right? So if your total income falls into above the 350,000 category, then you will be charged 36% even on your interest income, right? The good thing with unit trust is that because the returns quoted are after us paying WHT. So on certain instruments, you can deduct out of the 36, the 5% can be deducted for certain purposes. What kind of bond tenors do you expect CBSL to offer going forward? We will see a mix of 3, 5 and even 10 years going forward, because obviously a large component might come in the 3 to 5, but that doesn't mean that the government will stop raising money in the long end. And why the government has to raise long end money is because Sri Lanka has a gross financing need target of 13%. Now, to get to that 13% number, Sri Lanka has to increase its average maturity of its treasury bond holdings. The only way that it can increase its average tenor on the treasury bonds is issuing long-term securities. How does Cal view the real estate market and tourism market trends? Real estate market might remain a little bit slower from my view, particularly with all these tax changes and so on coming in. Tourism market trends and tourism real estate might be doing very well. And tourism market trend, tourism will have one of the best quarters in the December quarter. And even 2025 will be one of the best years. So tourism, from a property perspective, tourism properties should be doing very well in 2025. So what is the difference between fixed income opportunity funds and investment grade fund? Investment grade fund has only investment grade or BB plus and above instruments. We take a relatively higher risk on the fixed income opportunities fund, which is we have only a few instruments which will fall below BB minus, and we will take a relatively longer time horizon on the instruments on the fixed income opportunities fund. Now, that is perfectly fine given that Sri Lanka's economy is recovering and corporate credit risk is reducing. The opportunity is in the fixed income opportunities fund. How would external events like a possible war between Israel and Palestine affect the local market and possible impact on each of these investment products? So that's a black swan event that can completely derail things, to be honest. That could really, because Sri Lanka, a lot of it is dependent on 25% of our imports are oil, a lot of our exports are also to the Middle East. So it can have an overall impact on the economy. So for example, if oil goes to $100 a barrel or $120 a barrel, we will face issues on a balance of payment and so on, which will mean that you will see the currency depreciating more, and also we might have to push interest rates up to kind of match for scenarios like that, right? So that's a black swan event or possible risk that you can foresee that can derail our view in terms of interest rates. Market PR is about 8.5. Historical values are around 14. So the market is attractive, no? So 8.5 is not cheap when you look at countries like Pakistan, Vietnam, and so on. So that's the only reason, but it doesn't mean that 8.5 is a good number. Potentially, if we can maintain corporate earnings growth of about 15-20%, 8.5 times is a good number, right? 14 is a bit on the higher side, so even emerging markets trade at 14. But if you want to have a 14 times market multiple, your growth on earnings has to be substantial, right? 30-40% in terms of earning growth to justify a 14 times multiple. And typically we see a 14 times multiple only when rates are coming close to single digit levels, which is not still the case. Will the LKR depreciate after the resumption of imports such as vehicle imports? Yes, at the moment we feel that the currency has appreciated a little bit more than what we would want to see. From March next year, so from our currency, if you recall, we've always thought the currency will depreciate by the end of the year, and why we kept saying that is that we expected the vehicle imports to come this year in 2024, and we expected the debt restructuring payments to be made this year. Now what has happened is these payments are postponed to March, right? And vehicle imports probably starting from February, right? So the pressure on the currency will starting from somewhere around February, March next year. Post debt restructuring, you stated the country ratings will be upgraded. Do you think this bank ratings will also be upgraded, and so what impact will have on the bank shares? So bank ratings will also go up in line with the country ratings going up. But to be honest, equity markets price this in ahead of times. Equity markets are more efficient and they kind of respond to credit rating upgrades faster than before. So for example, the current movement in banking shares is a lot to do with expectation of external debt restructuring being completed and the possible credit rating upgrade coming in. Doesn't Cal invest the interest earned on fixed income opportunities fund in units? I don't see my daily interest increasing. Your daily the units, the price of the unit should be going up. The number of units won't increase. So if you have 1,000 units, the 1,000 units will remain constant. But what happens is the return gets added to your unit price. So you will see the unit price increasing every day. So only equities is a tax-free income, is it? As the capital gain tax is still not there and dividend is final tax, correct? So equity capital gain is 0 and dividends you pay 14% as final tax. Earlier T-bill interest is liable for a 5% final tax. What is the position now? Now whatever interest you make, you have to pay based on your tax bracket, personal income tax bracket, right? So if you say earn more than 150,000 rupees or 141,000 rupees, you end up at 12% tax bracket, right? If you're making more than 300,000 income, say you made 200,000 in your salary and 200,000 in on treasury bill interest, that anything above that 300,000, you have to pay that 36%, right? So that final 5% tax is no more, right? You have to pay your tax based on the personal income tax range. In unit trust, which one is better, fixed income or investment grade fund? What is the difference? I think I've explained this, but at the moment the yield uptick is better on the fixed income opportunities fund. So question is, FD also can't we apply same principle of unit trust, like reinvesting interest without withdrawing to postpone tax? The only way you can do it is you have to enter into a 5-year FD or something like that, right? Where the interest is coming at the end. You can't enter into a 1-year FD and keep rolling it over, will be treated as realization of income. If so, you have to pay taxes. The only way you can achieve the same result during FD is you enter into a long-term fixed deposit, like a 3-year, 5-year deposit. So the interest only comes in year 3 or year 5. In a 1-year FD, rolling over won't work, right? If in a 1-year FD, if you take the money out, that's treated as realized income and you have to pay taxes. So how they look at it is, if it hits your bank account, if the return hits your bank account, that is the point at which you have to pay taxes, right? So for example, in a 1-year bank FD, they'll credit your interest to you, that hits your account, then you're subject to pay, right? So in a bank 1-year FD, that's how it works. But you can achieve the same by entering into a 5-year FD or so on. In a bull market, do you believe it's advisable to invest in equity-based unit trust fund? It is an option. It is an option, particularly if you don't have the time and effort to pick the right stocks. What I personally believe is, at the moment, you've seen a good run over the last 3-4 weeks, right? At this point of time, you have to be a little bit more selective in terms of picking the right shares, right? Without buying the entire market as such, right? As I mentioned, the RSI is a little bit overheated. So you have to pick companies which are going to do well, which will benefit from the government changes and so on. So using a unit trust fund might be an advantage because someone is thinking about it, or fund manager is thinking about it and making a decision. Prediction of where the SPI will end by year end. 12,500 where it was before is where I think it can easily come up to. Getting to 13,500 will mean that interest rates have to fall steeper and external debt restructuring and all that has to end smoothly. If so, I think we can hit at about 13,500. Will there be a downtrend ahead of the budget? I don't think so. I don't think there'll be too many things coming up in the budget which will be detrimental. And it's still going to be in line with the IMF framework and so on. So shouldn't really cause major disruption for the market. Could you please explain what we can expect in terms of gold price? Gold prices, in a scenario like this where the central bank is easing, US central bank is easing policy and so on, gold prices tend to keep going up. So typically in dollar terms, gold prices should be hitting a new high in 2025. In your opinion, 30 to 40% gain on stocks such as banking, is it a good time to realize gain? Or does holding still a good strategy for long-term investments? I would say if most of the banking sector gains have already been realized, so whether you can make these kind of returns for a long term in the banking sector shares, I don't think so, because banks should kind of stabilize at about 0.7 times book and so on. My recommendation would be to shift to other sectors, given that banks have seen a substantial growth in terms of their prices. And the major benefit, I think, is priced in terms of the EDR reversals, impairment reversals and all that has been already priced in. What is the procedure for a Sri Lankan citizen to legally purchase foreign stocks? To be honest, you don't have a way of legally purchasing foreign stocks. Before this whole thing, I think in 2018 and before, they allowed you to take up to $10,000 or $15,000, and using that money, you were able to purchase shares. But at the moment, they have restricted entirely where you can't take money out, and these can't be invested for any other purpose. Even companies taking money out is restricted to a greater extent by the Central Bank of Sri Lanka. So it's a no-go at the moment. Please explain anticipated currency pressure in February, March. I think there's a possibility that the currency can go to about 320-ish towards March, April next year. Potentially because of the vehicle imports and the debt repayment starting to come in. Do we get a holding period return in a Cal unit trust? I'm not sure what you're exactly referring to. So holding period return is if you invest now and whatever you can, say for example, if you buy units at 10 rupees and the units increase to 15 rupees, 50% is the holding period return, right? So I'm not exactly sure in what context you're asking that question. So if there are no other questions, we'll stop the session for today, and hopefully we'll see you in a more insightful session, probably closer to the external debt restructuring being completed and the IMF program continuing. I think what is key to see is that as long as the government doesn't derail from the IMF program, is sticking to the policies, and Sri Lanka is collecting enough taxes to manage its fiscal position, the outlook of the country doesn't change. And if we maintain this momentum, it should be good for overall markets. Right? So on that note, let me wind up the session for today and hope to see you soon in another session.